Good morning. Don Yoakum here. Time for the Daily Brief, where I give you the big picture perspective to make this market work for you. Okay, next week, CPI is coming out again. We've got around 5.6% as the estimate on core inflation. And, whether it comes in above that or below that, that's not really the point. Inflation is going to ebb and flow, what I believe is what I believe is a higher trajectory. Right? And that trajectory is a result of the massive amount of money printing that they've done that they can't take off the market fast enough. And the demographics. There's a very strong secular trend in terms of demographic pressures, and that is baby boomers retiring, taking supply out of the workforce, keeping wage pressures high. So that's why we have an unemployment rate of around 3.4%. Okay, so that's the trajectory of inflation, and whether it comes out a little bit higher, a little bit lower next week is irrelevant. What I want to focus on is the market's unhealthy obsession with CPI prints. Also, the market's unhealthy obsession with the Fed funds rate. Healthy markets do not obsess about those things because there is price stability. They know what inflation rate is going to be. They have a very good estimate of what inflation rate is going to be and what it's going to be over the long term. Right. Same thing with Fed funds rate, which is the price of overnight money. They have a very good set of expectations around what the price of money is going to be over the long term. When they're obsessing about what that price of money is going to be, that means there's not price stability. There's a massive amount of uncertainty. So it's a sign of a very unhealthy market and a reflection of an unhealthy economy. Second thing, today, second piece of evidence. So New York Fed Chief Williams came out and spoke today, and he said that the Fed needs to keep interest rates high for a few years to kill off inflation. And he sees a peak rate around 5 and 5.25%. So that's what he calls high. That's what I take issue with. The long-term Fed funds rate is around 4.6%. We're not even there yet. And they're already calling 5 to 5.25 very high. That isn't high, right? It is high if the real growth potential is very low, right? 4.6% was the average because the real growth potential from the U.S. economy, and that's going back to 1953, was much higher. It could support that price of money. There was a demand for money that kept the price of money that high. Now, the real growth in the economy is weak, right? We let a lot of zombie companies survive in 2008. We kept a lot of things going that we shouldn't have, that should have been killed off in 2008, 2009, and we didn't. Anyway, so the economy, despite some very incredible things that are going on, right? There's remarkable innovation. The underlying economy is not in a healthy place. It's not in a high growth trajectory. And so 5 to 5.25% is considered high. Right? And that tells me that the markets are not going to go much higher. They can't sustain high growth rates, especially without the easy money policies that they had in the past. And the second problem is these underlying inflationary pressures eating away at any gains that we have. Anyway, that's my comment for today. Hey, I've got a pick for you in the Daily Pick. If you want to join, click on the link below. It's just $9 a month, and I'll see you tomorrow for another Daily Brief.